Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Citic Resources Holdings Limited Annual Report. Citic Resources Holdings Limited is a diversified investment holding company that operates in various sectors. At its core, the company engages in the exploration, development, and production of oil and coal in multiple countries across Asia, Europe, and internationally. The company's business segments include aluminum smelting, coal, crude oil, and import and export of commodities. The aluminum smelting segment operates an aluminum smelter in Australia, producing aluminum ingots from sourced alumina. The coal segment mines and sells coal in Australia, while the crude oil segment explores, develops, and operates oilfields in Indonesia and China. In addition to these core segments, Citic Resources Holdings Limited also engages in various other activities. These include alumina refinery, financing, oil technology development, and property holding. The company also provides consulting and management services, invests in bauxite mining, and trades in oil and gas. Furthermore, it exports commodity products and imports manufactured goods through its import and export of commodities segment. Overall, Citic Resources Holdings Limited is a multifaceted company with a wide range of business interests across various sectors. Its diverse operations enable the company to capitalize on opportunities in different markets and industries. The stock price of Citic Resources Holdings Limited has seen significant growth over the past year, with various financial data sources indicating a change of between 38.03% and 61%. While this growth is substantial, it falls short of the 82.3% increase mentioned in the query. Several key events and strategic developments have likely contributed to Citic Resources' stock performance. The company's strong 2024 annual results, which saw revenue surge by 148.3%, were announced in March 2025, coinciding with a 7% rise in the stock price. Additionally, the launch of a Singapore oil and gas trading unit in February 2026 has expanded the company's presence in Asia. The disposal of Alcoa shares in January 2026 for $247 million has also improved cash levels and balanced the investment portfolio. Furthermore, the resolution of tax disputes in Kazakhstan and Indonesia have likely alleviated concerns about regulatory risks. The company's focus on operational technology priorities and sustainability initiatives, such as IoT retrofits and digitalization of coal operations, are expected to drive cost savings and reduce environmental impact. Overall, while Citic Resources' stock price growth has been impressive, it is the culmination of several strategic developments and positive events that have contributed to its success. Citic Resources Holdings Limited maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Citic Resources Holdings Limited trades at a lower price-to-earnings ratio of 12 times and a lower price-to-book ratio of 0.61 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The company maintains a moderate leverage profile, with liabilities making up 35% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.08%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted the company's financial performance. On the positive side, the company has experienced significant revenue growth due to various factors. The aluminum smelting segment saw a notable increase in sales to external customers, contributing 50.6% to the overall revenue growth. Additionally, the crude oil commodities segment recorded a 21.7% rise in other income gains and losses, net. Furthermore, the company's expansion into new markets, particularly in mainland China, resulted in a staggering 237.4% growth in revenue. The Hong Kong market also presented opportunities for significant revenue generation, while the three major customers contributed to an increase in sales revenue. The trading volume exceeded 20 million barrels, resulting in substantial trading revenue of approximately $11.34 billion. On the other hand, the company faced challenges that led to a decline in revenue. The oil and gas business experienced a 15.3% year-on-year decrease due to fluctuations in international crude oil prices and rising operating costs. Furthermore, equity production declined in various regions, including Hainan Uidong Block, Seram Island Nambula Block, Indonesia, and Karajambas Oilfield. The coal business also suffered a significant decline of 79.8% in revenue due to a decrease in coal prices and rising costs associated with equipment maintenance and repairs. These factors highlight the importance of market conditions, competition, and operational efficiency in driving revenue growth or decline. The net income of a company has undergone significant changes across its various business segments. In the non-oil and gas sector, net income decreased by 43.5%, indicating a substantial decline in profitability. This decrease is attributed to increasing prices of alumina raw materials, which have put pressure on profit margins. In contrast, the coal business has also experienced a decline in net income due to sustained low coal prices and rising costs associated with equipment maintenance and repairs. These factors have cumulatively led to a decrease in profit margins for this segment as well. The overall impact of these changes is evident in the company's net profit attributable to ordinary shareholders, which decreased by 20.3% and 79.8%. This decline highlights the challenges faced by the company in maintaining its profitability across different business segments. The company's financial performance indicates a steady increase in operating cash flow. In 2023, the company generated $123,191 from operations, which rose to $234,119 in 2024. This trend continued into 2025, with an operating cash flow of $3,524,620. The availability of sufficient resources to meet working capital requirements further supports this positive outlook. Overall, the company's ability to generate positive operating cash flow is a testament to its financial stability and growth potential. The company's debt level has undergone significant changes in the recent period. The total debt has increased by a substantial amount of $708,960, rising from $10,990 to $718,950. This increase is largely driven by bank and other borrowings, which have risen by 81.1% to $718,950. On the other hand, lease liabilities have decreased by 15%, indicating a reduction in this type of debt. In terms of interest expenses, there has been a notable increase across various categories. The interest expense on bank and other borrowings has risen by 23% to $54,020, while the interest expense on lease liabilities has increased by an astonishing 316% to $5,261. As a result, total interest expenses have also seen a significant jump of 29%, reaching $9,281. These changes suggest that the company is facing higher costs associated with its debt obligations. The company's performance across various segments and regions has been mixed. On the positive side, the import and export of aluminium have generated significant revenue, with a total of $24,671,162 in the 2 pages mentioned. The crude oil segment also performed well, contributing $17,272,266 to the overall revenue. In contrast, the coal segment struggled, with a meager total revenue of $1,531,269 across the same period. This indicates that the company's efforts in this area have not yielded the desired results. Overall, these findings suggest that the company needs to focus on improving its performance in the coal segment and potentially diversifying its aluminium export markets to achieve better overall results. Management's outlook on company strategy. the management of the company has outlined several key areas of focus for the future. Firstly, they will prioritize oil and gas development, production, and trading as a core area of business. Additionally, investments in the aluminum industry chain are expected to be a significant focus. The company aims to consolidate its existing principal business while expanding into new areas through its investment plus trading dual-wheel strategy. The ultimate goal is for the company to become a leading resource and energy-focused listed company. To achieve this, management emphasizes the importance of maintaining a strong financial position with increasing cash and deposits balances. Effective risk management is also crucial, as internal policies and procedures have proven effective in managing various risks. Overall, the company's diversified business strategy will continue to expose it to various risks, but management is confident that sufficient resources are available to meet foreseeable working capital requirements. There are growing concerns about inventory buildup and supply chain disruption in the industry. The significant increase in aluminum sales by 13.2% suggests that demand is outpacing production, potentially leading to stockpiling of inventory. Furthermore, the ongoing coal shipment bottlenecks, although partially alleviated, indicate a fragile supply chain that remains vulnerable to disruptions. The rising costs associated with equipment maintenance and repairs in the coal business are an added concern, as they may further exacerbate supply chain issues. These factors collectively point to potential problems in managing inventory levels and maintaining a smooth supply chain, which could have far-reaching consequences for the industry. That concludes the financial summary for Citic Resources Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.